The economy is growing and everybody's happy. And so are you, because this is where the money is. Welcome to the show. I'm Matt Copenheffer. This is David Hansen. David, the college basketball season is off and going. Predictions early in the season. Who are two teams that you think will end the season in the top 5?
I don't like this team, but got to go with Duke. I've watched him play a couple times. Freshman Jabari Parker, pretty unbelievable. Are you marking down my predictions?
Yes, I am.
Me to it?
Yes, I am.
It's impressive.
We like to be accountable here.
He's an impressive specimen.
Okay. Duke?
Yes, that's it.
That's it?
It's the only one I got.
One prediction?
Yeah, that's it.
And it's Duke?
Yeah.
It's not exactly a bold prediction there.
Sorry.
All right, let's go to the headlines. First headline of the day, we've got Reuters. U.S. third quarter growth revised up to 3.6%. Jobless claims fall. The advanced estimate here, which is basically the estimate where they say, we want to tell you something, but we don't have a whole lot of data, so we're just going to throw a number out there. That was 2.8%. That was obviously very wrong. It's now 3.6%. That's a lot better. Second quarter, 2.5%. So we've gone from 2.5% annualized growth to 3.6% annualized growth. That's better. 3.6 is better than 2.5%. I'm not sure if you
I think so.
would have picked up on that. Consumption expenditures, consumer spending basically slowed down. That's not really ideal. A big bump during the quarter was inventory builds, and I think there's some sense in the media coverage that, oh, a lot of this had to do with inventory building, so that doesn't really count. Sure, it counts. Businesses are building inventory because they expect to sell things. That's why they do that. That's a sign of a growing economy. It's not necessarily the kind of thing that we'll see repeating quarter after quarter, but I don't think it's a bad sign at all. And of course, federal government. Growth down contracted 1.4%. So we continue to have the government playing a drag on our economy, which is really exactly what we want from the government at a time when everybody's concerned about the economy. Let's have it pull back growth.
Yeah,
That's what I like to see.
I saw the same thing about the inventories as you. Everyone was like, nice number, but it was all inventories, guys. I'm like, does everyone just like not know what inventories are? And they're just going to be like, no one understands it, so it's bad.
It's mostly Beanie Babies.
Yeah, I don't know. So I think it's fine. And we talked about it last week on the show with Morgan that GDP is not really a good indicator of where the stock market is going historically. Just because GDP is growing does not mean that the stock market will definitely grow. So just temper your expectations if you're looking at GDP and saying, oh, this is what's going to carry the stock market going forward. It's probably not going to.
Fun fact, though, GDP does predict quite well how well gross domestic product is growing.
I would hope so.
Second headline.
All right, second headline is a trifecta. We have three headlines here, and it's
Triple
all
A.
Bitcoin. First one is China restricts banks' use of Bitcoin, and then Alan Greenspan says Bitcoin a bubble without intrinsic currency value. Last one, chief of police asked to be paid in Bitcoin, and the city approves. Wow, we've got a lot of Bitcoin
I love all these
headlines here, and I
love
don't
these
even
all.
know where to start. So when China came out and kind of did not put it as a currency, and they said we don't see this as a currency, and some people think that's the Chinese trying to manipulate their currency and have control over it and whatnot. It hurt Bitcoin. Bitcoin fell about 20% after those news. After that news,
made us poor since we have 0.12 Bitcoin.
Very disappointing there. But again, 20% in the world of Bitcoin, we've talked about that.
That's like a daily move.
That's a daily move. So maybe not a huge story there, and not a surprise what Greenspan said. I mean, I don't know if there's many kind of academics, if you will, that are saying that this isn't a bubble. I don't know. What do you think?
About Greenspan?
Do you think it's fair? Is he just saying that because everyone's saying that, or do you think he actually thinks this is?
I think he probably actually thinks it. Whether I don't know. I actually pulled out a quote from. This is his quote. He said, "It's a bubble. It has to have intrinsic value. You have to really stretch your imagination to infer what the intrinsic value of Bitcoin is. I haven't been able to do it. Maybe somebody else can." I mean, that's kind of true, but to the proponents of Bitcoin, when you think about a dollar, what's the intrinsic value of a dollar? So it's really the faith in the currency itself, and it's the faith in the U.S. economy and the U.S. government and its ability to levy taxes and keep the economy going. And so it's faith in the currency. So to the extent, and I'd also say that it's faith in the idea that you'd be able to use this currency as a medium of exchange to buy goods and services and all of that great stuff.
I mean, it's the same thing that we hear about gold. We hear the comparisons between Bitcoin and gold all the time, and it's the same thing. What's the intrinsic value of gold? There's not a stream of cash flows coming from it, so it's a similar proposition.
But at least with gold, as I've done before, and I haven't updated this analysis for forever now, but you can look at the gold to oil ratios and gold to wheat, gold to dairy and that sort of thing, and look at relative values of gold, so you can kind of get a sense for that, and you can exchange gold for things. So I think there's maybe a little bit more of an argument that there's intrinsic value there.
And the chief of police getting his paycheck in Bitcoin.
Well,
have you talked to HR to do that yet?
Well, yeah, right. So here's. I wish him all he's kudos to him for being on the bleeding edge of the new currency, to actually be getting a paycheck in Bitcoin. And for those curious, the way the city is doing this is in Kentucky, Vico, I think it is, Vico, Kentucky, or Vico. They are taking out taxes and all the other deductions before they convert to Bitcoin. So they're taking that out in U.S. currency and then paying him in Bitcoin. They're probably not using VeerWalks, which is what we did.
They're not.
A lot of fees. I hope that this doesn't prove out to be true, but the first thought in my mind is, joke's on him when he tries to go and actually buy dinner for his family, buy food for his family with that Bitcoin.
Not so easy.
You and I tried to buy Thanksgiving dinner with our Bitcoin. Didn't exactly work out.
Good luck to him, though.
Third headline of the day, we're going to American Banker here, and we're talking Blockbuster. Blockbuster Video, a cautionary tale for bankers. What does Blockbuster Video have to do with the banking industry, David?
Maybe nothing specifically, but the author there, Dave Martin, was...
Bankers like to watch a lot of movies.
They do, maybe.
They do.
But he talks about how Blockbuster, we see it now as this big failure, and oh my gosh, how could they completely miss the streaming boat? It was a terrible strategy. He talks about when Blockbuster was kind of on top of its game, and it was everyone envied its business model. It had so much data on all of its customers, it stocked with the right movies, it had a great supply chain, it was a great business. But they kind of just got sideswiped by this technology here. And one of the quotes he says in there is something along the lines of, it's always easy to point out kind of the failed strategies in industries other than ours. And he kind of cautions banks, don't get too complacent with kind of just your traditional model. There can be changes to the industry. And we're potentially seeing that with internet banks. I know you and I were talking before that you don't see it quite the same as a Netflix coming in and stealing all of Blockbuster's business as internet banks stealing all of the big banks.
Right, because it's easy. Well, and we could probably say the same thing for Amazon. I feel like I've been bringing up Amazon a bunch of times on the show recently, but Amazon or Netflix, think of Amazon early on just as a bookseller, and we can think of Netflix early on as shipping out the DVDs. You can be centrally located and have people come to you on the net, on the web, and distribute books, sell books, or distribute DVDs all over the country, and that's a viable model. Within banking, you can. I think you can kind of do that with deposits. You can attract deposits that way, and we've seen Bank of Internet be really, as an example, be really successful with that, being able to attract a lot of deposits, and you can get them from all over.
And even the bigger ones like Capital One too. I mean, people go to Capital One. That's an easy internet bank, kind of use internet interface.
Sure, and they got the ING Direct platform, which was also very successful at doing that online. The problem is that in order to make money as a bank, then you have to turn around and take those deposits and lend them out profitably and well. And so the thing is that if you are, I think Bank of Internet's headquartered in San Diego, right? So if you're headquartered there in San Diego and you don't have a presence in, say, Vico, Kentucky, which we were just talking about, then it's going to be a little bit more challenging, or a lot more challenging, or impossible to make really good loans in that particular market. Now, maybe for a standard residential real estate kind of transaction, maybe you can get away with that. Maybe if you're making a a loan with a low LTV, with a low loan to value ratio or something like that. You've got a lot of protection around it. But for small businesses and for other types of loans, you want to be on the ground there, so you know the economy, you know the lay of the land, and so you can make good loans. So that would be the thing that would worry me about thinking of banking in terms of like a Netflix type of business, because you can get the deposits okay, but then you've got to turn around and make good loans, and I think it's more difficult to do that if you're not on the ground in a lot of these places.
Very interesting story to watch, though, kind of, if it gets disrupted. And it's a good article. It's over on AmericanBanker.com.
Yeah. So. And I think regardless, I think the idea that banking becomes more flexible and less branch heavy, I think that's a reasonable story.
Yep.
Much lighter business model. Moving on to the focus for today. David, this was an idea of yours, so I'm going to kick it right over to you. It was, you thought we should discuss maybe the idea of building a simple bank model. So when we're thinking about investing in banks, how would you build a model from the bottom up to evaluate whether a bank's a good investment?
Right, so we're talking about all the time on the show, and people say, well, that bank sounds great, the strategy sounds good, but I get a little bit scared. I don't know how to model things out. I don't know how to build a big Wall Street model out there. And I don't think that's necessarily needed in order to make an investment choice. I like to run the numbers. I don't like to build out huge spreadsheets, because you're putting a lot of assumptions in there that could change drastically over the course of kind of the next 5 to 10 years. So my process and kind of the simple model would be to look at the business first. I think you have to like the strategy, like the management team, before you go in there and start to plug numbers in. So kind of where I start is, what is it trading at today? And we talk about price to book value, price to tangible book value, and kind of what's that today, and what's book value? What is the book value per share of the bank today? And how fast can they grow that? How much can they grow that over 5 to 10 years? I usually use a 5-year period. So you can kind of say, if they grow it at 5% a year for 5 years, book value will be X in 5 years. And then you can kind of assign, this is where it gets a little bit more prediction-y or probabilistic, what is the multiple going to be in 5 years? And I think that's when you can kind of plug different multiples into your model and saying, okay, if book value is now 50, what does it look like with a 2 times multiple? What does it look like with a 1.5 times multiple? And kind of play with that and see what are the ranges here? What is probabilistically accurate-ish? Accurate-ish. And that's what you have to remember with building models. It's not going to be specific. You're never going to model anything out 100% correctly. And that's fine. I think you have to accept that. But it's asking yourself, is this reasonable? Are there strategies in place to get there? So that's kind of just a back of the envelope. Do it in a couple cells in Excel, and I think you can get a better idea about where the valuation sits today.
So just this is more of that's a good explanation. This is more just a recap of what you're saying now. But the eventual return that you're going to get as an investor is going to be the difference between the price that you pay today, the price that you get on the other end, and the cumulative dividends that you receive along the way. So what you're going to look at is you're going to look at the price today, and then, like you were talking about, 5 years from now or 10 years from now, you're going to think about, well, what's the tangible book value going to be, and what's the multiple going to be on that tangible book value? So then that tangible book value part of it, so the question there is, you're going to look at over time, you have your starting tangible book value, and then every year that's going to increase, hopefully increase, some amount every year, and that's going to increase again, we're talking simple terms here, by the amount of the net income that's being added. You're going to take out the dividends from that, you're going to take out share buybacks from that, but basically you're adding on the net income every year. And then how's that net income, how do we get to that? Well, that's going to be your net interest income. Right. It's going to be your non-interest income. You're going to back out provisions. You're going to apply an efficiency ratio for that. And efficiency ratio, again, it's just basically all of the costs, and it's a ratio. So if you're multiplying by that, it would be 1 minus the efficiency ratio. And then you subtract out the taxes. You get your net income there. So you apply that out year over year until you get to your 5-year or you get to your 10-year. And then what you'll end up with is you'll have your price today. You'll have your price at the end there, or I'm sorry, you'll have your tangible book value today, tangible book value at the end there. Like you said, you have to apply some sort of multiple there, and then you have your change, and then you add in all of your dividends. Now the trick here, and you touched on this as well, is the whole garbage in, garbage out thing. If you put garbage numbers in there, you're going to get a garbage result. So you want to try to be as realistic as possible while still understanding that you're predicting the future here.
Right.
And I like what you said about probabilities, probabilistically, because that's the way you've got to think about this. So it's not just over the next 10 years this is going to grow 5%. It's more like, what is the most likely scenario? Okay, so maybe 5% is the most likely scenario. So I'm going to put the most weight on the returns I would expect to get if it grows 5% per year. But then it could also not grow at all. But then it could also grow maybe 7 or 10% per year. So you want to look at a bunch of different scenarios. Same thing with that tangible book value multiple. You want to look at different scenarios of what you could end up seeing at the end of that period.
Cool. Yeah, and I think it just helps to get some numbers on the paper. I think you'll understand the business a lot better and kind of what can you expect. And if anybody's listening or watching and wants to put it into an Excel sheet, have any questions, send it over to us, WTMI@fool.com. We'll take a look. Why not?
But and I will just stress that these are just the numbers. This is just an Excel model.
Yeah, very simple.
You said this at the beginning before you started. The first step is to understand what the strategy is of this bank, what they're doing, who's running the business. Because if you're not comfortable with that, if you don't know that, all of these numbers are just gibberish.
Yep.
They're going to be useless.
Cool.
All right. You said email?
I said email.
We're going to move on to mailbag. Our email address, WTMI@fool.com. Love getting those questions and everything else. Got a question here from Zach. Said, I appreciate the focus on the business, management, market position, moat, etc. Once we have become comfortable with the business and its model, that is, we're ready to invest, when is it appropriate or more advantageous to purchase preferred versus common stock?
We don't talk about preferred a lot.
We don't. And part of I'm not really that interested in preferred stock, I'll be honest.
Right.
There's going to be, for me, I'm still relatively young. I got a long runway before I'm going to be retiring. There are very few circumstances where I'm going to get super excited about buying preferred shares. If I like a business, I'm more likely to be it's more likely that I want to be involved in the most upside for that business.
Yep.
With preferred shares, generally, if you're looking for, and this is a broad generalization, if you're looking for more yield, if you're looking for more income, preferred shares can sometimes give you that while giving you some amount of the equity upside. But generally speaking, I don't even. This is just me being honest. I don't even bother with preferreds. It's not something that I'm interested in.
Yep, I'm similar to you, relatively young guy, I guess. Exactly. So yeah, unless I think you're nearing retirement or older in age, you kind of just want the security of the dividends, the preferred dividends that flow in. I don't know if it makes a ton of sense unless you're just a really conservative investor, and then it could be fine. A couple of things I wrote down just to look out for if you're interested in the preferreds, whether to see if it's a cumulative preferred or non-cumulative. If it's non-cumulative, if they miss a dividend payment, they missed it. You don't get it back. If it's cumulative preferred shares and they miss a payment, they have to make that up to you over time. So maybe better, I don't know, to get a cumulative dividend if you're worried about potentially missing dividends there. And then just be aware of if it's trading at a premium to par. Most of these can be called by the bank, by the company, at any time, most of them. So if it's trading at a big premium and they call it, they call it at par, so you lose your money there too. So just be aware of if it's a premium or a discount. I think they can be interesting, but maybe not for a young investor. But for an older investor, I think it may offer some good income.
Well, I will say in their camp, just like anything else, if you're able to find preferreds that are mispriced, that can certainly make sense. And if we look back to the financial crisis, there were plenty of financial stock, financial company preferreds that you could find that were mispriced.
Yeah.
So you can get upside there. But again, I mean, even if you look back to there, maybe you slept better owning those mispriced preferreds, but you would have been better off, I think, probably in every case, almost every case, if not every case, being in the equity. So I think it's a combination of what you're looking for and how you sleep at night. Yep. Distributing between equity and preferred, but generally speaking, almost always I prefer to be in equity.
Cool. Game for the day.
Yeah, we do have a game today. That game is
Full in the blank.
Full in the blank. Which you're gonna surprise me, right?
You do not know these.
I do not know these because I did not help you come up with them. So let's go to the first one. Blank is the biggest hurdle for banks today. I'll let you answer first.
So you can think about it?
So I can think about my answer.
Biggest hurdle today, I don't think it's regulation or anything like that. I think it's just patience. We're in somewhat of a low return environment, and I think you want to find banks that are just being very patient. And they're saying, we're not going to reach for loans. We're going to stick to our business model here. We're playing for the long term. So I think patience is the biggest hurdle.
I'm going to go with, I was thinking in my head between loan demand and net interest margin. I think I'm going to go with net interest margin. It's one of the biggest hurdles today because it really is crimping what the banks can earn. But it's also one of the biggest opportunities because when net interest margin starts to expand again, you're basically getting more free income.
Cool.
Which is nice.
All right, second scenario.
We got blank is the last stock I bought. David.
Yes, it was Annaly Capital Management, and it was not the first time I had bought the stock, and my first position was relatively small. Stock went down. I liked it at the first price. I liked it again after it went down and was even cheaper than I bought it before. So increased that position a little bit. I think the outlook is still good for the next couple of years. What do you say?
My most recent purchase wasn't for my personal portfolio. I actually have a real money portfolio on Fool.com that people can find by Googling my name. So I bought a trio all at the same time there. I got AIG, I got JP Morgan, and I got Citigroup, AIG, and JP Morgan both up to my positions in that real money portfolio. In both of those, Citigroup was a new position for me in that portfolio. All three of them I'm positive about. AIG is my largest position in that portfolio. Very positive on what's going on at that company and what the future looks like.
All right, last scenario.
Final scenario. Blank is what I would name my de novo bank.
So we saw Bank of Bird in Hand earlier this week. So what would you name your de novo bank?
I would name it The Dude Abides Bank Shares.
That's what you're going. That's a little long.
Well, it could be El Duderino Bank Share or Duder Bank Shares. Duder Bank Shares.
Interesting.
But it's because my bank would be boring. It would be laid back, and it would just be about making good loans and earning great returns by doing simple, good banking over a long period of time.
Going with Bank of Awesome.
Bank of Awesome. How could people not want to bank at
Yeah, you'd be like, awesome card. That's your debit card. Who doesn't want that?
I'm on board. Let's start the bank.
All right.
Bank of Awesome. All right, finish it out. We're going to the Twitter sphere. David, what's our first tweet?
First tweet is from Andrew Pogue. He is at Underlying Value. Great morning already with Goldman Sachs coming out with buy recommendations on Radian and MGIC, $17 and $10 targets respectively. Both of these stocks have had an incredible 2013. These are the mortgage insurers that had a terrible time, still having a terrible time from a business perspective, still booking losses in most of the quarters here. Goldman Sachs coming out with a buy, and these stocks, the valuations have gone crazy this year because the market's forward-looking and saying, okay, we know they're unprofitable today, but going forward, they're eventually going to be profitable most likely. So, interesting recommendation by Goldman Sachs. I think it's reasonable. I'm not going to call Goldman idiots, but.
Do you think it's reasonable? Are you excited? Are you gonna?
I'm not.
Does this put either of them on your buy list or on serious consideration list?
Not a serious list. Maybe it puts it on a. I'll watch them maybe a little bit more now, but.
Fair enough.
All right.
Second tweet. Luann Lofton, the Fool's Own Luann Lofton. That's at Luann Lofton. I like big gains and I cannot lie, but what to do when a big gain turns into a heavy weight in your portfolio? So in this article, Lou's talking about Chipotle and how much of the stock has done really well. Would you say 800% for her?
Over 800%.
Over 800%, and now it makes up a big chunk of her portfolio. And she's basically musing on, because it makes up a large chunk of her portfolio, does that mean that she should sell some of it to bring that back down to size? We had a healthy debate going before we started the show. You not in favor of selling any of the position?
Not necessarily, unless she thinks it's a ridiculous valuation today. I don't see what's the point of selling it. Okay, if it makes up a big part of your portfolio, unless that's going to affect your behavior, which is what you were talking about before we started filming, I don't think it makes sense to sell. I mean, if you think the company still has room to grow, why do you necessarily care if it's a huge part of your portfolio? You're not a fund manager that's going to be impacted if Chipotle has a bad year and you have to tell everyone, hey, look, everyone, we had a really bad year because of Chipotle. I think if it's your money, you have an optimistic outlook, I don't think you sell. But you were a little bit leaning to sell.
I was just more. I was more of a balanced perspective, devil's advocate. I like to take that role. I think there are valid reasons why you would sell some of that. But if it were me, you know, the thing is that we're thinking about in 5 years, we're thinking about 10 years, periods of holding these stocks for long periods of time. We don't want to sell just because something's down. So I don't know that we necessarily want to sell just because something's up, because we may be missing out on a whole lot more upside in a great company. Final tweet. David, you know,
Steve Evans, at Steve_E. I think Matt at Cope the Fool, that is your Twitter handle, should go speak to the, quote, dumb money to ask it if it's here to stay. And he's referencing the video or the segment we did yesterday on the reinsurance market. And I guess you called some hedge funds, some big institutional investors, dumb money coming into the space.
I forget precisely what I said. Maybe I was a little bit flip, but frankly, two things here. First of all, when there's the eventual shakeout, a lot of the new money that's come into the reinsurance space will end up looking like
maybe that's the better term, new money, not dumb money.
You didn't let me finish. Okay. Will end up looking like dumb money. The second thing I will say to that is that go talk to the dumb money. Well, dumb money, no matter when it is, no matter if we're talking retail investors in 2000 or real estate investors in 2006, dumb money doesn't know it's dumb money when it's pouring in. So not all of the new money coming into the reinsurance space is dumb money. But when the tide goes out, to use Buffett's term there, when the tide goes out in the reinsurance market, a lot of that, or at least some of that, is going to look like dumb money.
A lot of nudity.
A lot of nudity. All right, that's the show for today. You can tweet us at TMF Financials, or as Steve found, at Cope the Fool. That's my personal Twitter handle. You can also email us, WTMI@fool.com. I'm Matt Copenheffer. David Hansen over here. We'll see you tomorrow.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.